Hello, everyone, and welcome to today's webinar, Driving World-Class SME Lending Experiences, How to Power Rapid Approvals and Accelerate Your SME Lending Processes. I'm Julie Muhn, Senior Research Analyst with Finovate, and I'll be your host for the next hour or so. Today, I'm joined by a group of panelists, Alex Daly, Chief Finance and Risk Officer with Ask Inclusive Finance Group, Corinne Llelti, Commercial Sales Director, EMEA at Provenir, and John Pesavento, VP of Technology at Reliant Funding. Today, we're going to be discussing powering faster, simplified application processes, making smarter, faster decisions, and getting to market faster, future-proofing your decision technology to keep up as market trends and demands evolve, and using advanced predictive analytics like AI to keep risk in check. I do have one housekeeping note before we get started. We will have a Q&A session during the last 10 to 15 minutes or so of today's session. So please enter your questions at any time in the Q&A box in the platform, and the group will be addressing those questions at the end of the discussion. So let's kick things off with some introductions. Alex, please start us off.
Hello, I'm Alex Daly. I'm the Chief Finance and Risk Officer at Ask Inclusive Finance. For those who do not know what Ask Inclusive Finance does, we tend to try to lend to small and micro-sized businesses who have typically been turned down by the mainstream banks and the likes of Funding Circle and other algorithmic-driven lenders.
All right. I think you might have cut off there a little bit. Corinne, how about you go next?
Thank you very much, Julie. So yes, Corinne Llelti. I'm the European Commercial Director at Provenir. Provenir is all about automation and optimization of business decisions. The sort of results that we bring to our clients are things like being able to process 60 loans in the time that before you could do one, getting conversion rates up by 10%, and all of this in a platform that can go live in about 3 or 4 months. And we're very proud of our record, which is a very switched on client who managed to do it in 38 days. And all of this with access to all the data you might need to do it, and with explainable AI, which is a massive plus to our sort of worldwide portfolio of SME lenders, going from sort of BBVA at the top end to the newest startups in this space at the other end.
Great. All right. And John, finish us off here.
Sure. Good morning. Glad to be here. John Pesavento, VP of Technology for Reliant Funding. And we are a small business lender, merchant cash advance, as well as portfolio lending. And we serve the needs of the small business community across the United States.
Very good. All right. So let's dive right into the discussion here. So let's start off by talking about alternative data. How can the use of alternative data help lenders make more accurate credit decisions when providing funding for SMEs? And what are some of the challenges faced in accessing and using this alternative data? Alex, let's start with you on this one.
Okay. So first of all, the question is, what is alternative data? And we're assuming that that means other than pure credit bureau data. So in my mind, that's things like using Google ratings, using Google Maps to do telemetry calculations, distance calculations between data points, I've even seen Street View being used to identify whether the customer knows where they actually live. And other areas that people are now extracting information is through Facebook and a lot of e-commerce data, whether it's eBay's platform or Amazon's platform, device fingerprinting. And more recently, you've got things like open finance, so accessing the management accounts online for your borrowers. And something that Ask If is really progressing with is psychometric testing of borrowers. So then the question is how can you use this data and how do you make it more accurate credit decisions? And that comes in a number of different ways. So first of all, you've got the likes of data triangulation. So you can compare different points of data to see whether what the borrower is telling you or what you found out about the borrower is consistent. Things that we're using is looking at automating the reviews, the average reviews from Google, and bringing that into the underwriter portal. So if Google is telling us that the place is closed or it's got very poor reviews, then obviously that's going to be reflected in the underwriting decision. But the one area that really interests us most is around how do we tell the difference between a good borrower and a bad borrower using psychometric assessment. And our focus at the moment is assessing the applicant director. Typically it's a small business, so there'll be only one or two directors, and asking that director a series of questions to identify whether they've got traits in their personality which isn't being shown up on the credit reports. And this is not only being used in finance, it's also being used by HR and other businesses. And we can then look at the results from the psychometric testing to traditional credit reports and see whether there's a correlation. And the example that is given by a number of vendors is you may have two people living in the same street with the same credit score and the same income, but their personalities are very different. One might be a risk taker, one might be a non-risk taker, and depending on your lending appetite, that could affect your decisions. And then the final point, which is around what are the challenges facing accessing and using alternative data? Well, we all know about decisioning engines, and they've been around for a while. But when you talk to the providers of decisioning engines, they often can't actually get to the API data themselves. You need to buy another solution that will do that. Or if you ask a decisioning engine, can you call another API once you made a decision, they just frown and look a bit frightened. So one of the things that we've done with Provenir, which is our core platform for making decisions, is being able to quickly integrate to different APIs that we require, whether that's Google, whether it's psychometric, whether that's bureau data. And the benefit of the solution is that even I have managed to do my own API connection in an hour and a half and get some information out of Experian. And if you've ever worked with Experian, that is quite an achievement. And equally, there are other package providers who simply can't connect to other providers, and so you need to buy additional tools for their solution to work. So hopefully that gives you my opinion anyway on why alternative data is really powerful in this space.
And I think I agree with that. And I think just to add to that, sort of from a sort of high level point of view, it's really important, because if you think about it, the SME space is so dynamic. Relying on traditional sources of data when you're talking about startups that were only created a couple of days ago is like really tough. So, you know, like Alex was saying, some of these newer forms of data will actually give you a better view, and you actually get something to make a decision on. And it allows you to automate that process. Whereas before, when you were just using traditional forms of data, the companies that fell through those cracks, you'd have to go through a very manual process, which meant obviously longer lead times for them, and a lot more complicated process with a lot more dropouts for the companies offering that financing. And, you know, I'm sure Alex will tell you that, you know, being able to access those alternative sources of data means that you can fill in those holes with those, you know, newly created companies, which is important.
Yeah,
that's right. I mean, the issue is also not only do you need that data to make decisions, because the banks just simply turn them down on credit reports. Yeah. The bank simply can't get hold of the data. You try and ask them to integrate Google into their legacy platform, and maybe in 2030 you might get it on their delivery plan. I think that's the other thing, is they can't simply move quick enough to bring in new data sources, even if their teams want them, because it's just too difficult. And I think that's the benefit of having a solution that allows you to easily customize it and takes the work away from the technology team.
And I don't know,
maybe one additional.
I
was going to say one additional sort of challenge, I think, with alternative data is really understanding which alternative data elements, right, provide the right signals relative to what you're trying to achieve as a business, right?
Yeah.
You can procure a lot of third-party data out there, and if you sort of go into it without a thoughtful understanding of what's going to differentiate us from our competitors and what data gives us those signals, you could sit there and swarm in a data lake for years, right, and not get the answer you're looking for. So there's just as much as business accountability to say, what are we trying to answer relative to predictability and or information around credit decisioning that we can't answer today? How does, you know, alternative data augment that, and what are the right third data elements, you know, alternative data elements that give us the appropriate signals relative to what we're trying to achieve as a business. And I think if you sort of focus on that, then you can very quickly filter through what data sources are meaningful for your organization and what data sources are not meaningful, because not all data is important. And I think organizations sometimes worry about, well, let's just get as much data as we can. We'll put it in a big data lake and then we'll figure it out later. Well, there's a lot of wasted time that could go into that, building infrastructure, building capabilities, when you're not answering a fundamental business question, which is, how do we want to differentiate ourselves in the marketplace, and what alternative data that supplements our first-party data allows us to achieve that differentiation?
Yeah, so taking that focused approach. Did anybody have anything else to add on that one before we move on? All right, so let's talk a little bit about leveraging AI. Obviously, AI has been a huge hot topic in fintech for the past 5 years or so. So what are some of the ways that AI and machine learning can be used to make more accurate predictions? And what are some of the challenges you're seeing in deploying AI? Alex, let's start with you on this one.
Yeah, so in a previous role, we deployed neural networks and fuzzy logic in a consumer credit space. And so what we found was that it was quite a bit more predictive than using standard logistic regression models. And because we had sufficient data, we had the ability to do quite a large retro to prove that actually we were lending probably to the wrong people. A lot of our early model was based on face-to-face interviews and face-to-face decisions. And what we realized was actually that there was a correlation that just because you presented well didn't mean that your business was going to be successful. And equally, a scruffy dressed person didn't mean that they weren't going to be successful. So we found that implementation was relatively straightforward. We integrated third-party data into this neural network solution, which gave us the score, and we also used fuzzy logic, which helped us identify the reasons, strengths and weaknesses for that particular applicant. And in terms of the challenges, obviously in the UK, the regulator really doesn't like the fact that you can't explain why you've declined a customer. And that's where things like fuzzy logic tries to explain the strengths and weaknesses of the borrower.
Yeah, interesting. Does anyone have anything to add on that?
Yeah, for us, I mean, what we've really tried to do with AI and machine learning is really take a holistic approach for what we call the entire funnel. And that's from initial interest of a small business all the way through to funding and contracting. And we've tried to use AI to really understand the predictability at each inflection point in that funnel step, right? From initial interest of the merchant all the way through to the viability of their application, from a lead, right, all the way through to propensity to actually approve them based on, submission characteristics, right? And so the benefit of that is, as you know, right, the further you get along in a process in any organization, the more costly it is, right? So if we can use machine learning and AI to be more predictive on the propensity for a merchant to convert into of funding, then we actually have cost efficiencies that we're going to gain as an organization by doing so, as opposed to running everybody through the process and then only the approved ones sort of fall out, and then you have the fallout associated with who actually accepts an offer or not, because there's many competitors out there they can choose from. So really embedding AI and machine learning throughout the sort of value chain, if you will, right, at important inflection points where you're incurring material costs as you move through that process is really kind of where we've focused, right? And I think one of the challenges we've seen in doing that is, like anything else, and Alex sort of highlighted this in some of his commentary, there's always nuances, right? Like he was talking about the person and whether you're dressed a certain way, right? We don't do in-person interviews, right? But characteristics matter, right? And so there's always exception processes. And so when you implement AI and machine learning, if you're trying to drive a fully digital sort of end-to-end supply chain process that's, frictionless and touchless in terms of the human interaction, you have to be mindful of the exceptions, right? And how do you programmatically allow AI to facilitate the exceptions where appropriate, versus having, constant points of manual intervention, which are much more challenging and harder to address. So that's one of the challenges we continue to work through as we implement machine learning and AI. We ask ourselves, okay, is this particular piece that we're trying to leverage AI for, do we find ourselves having to, account for 20 different exception scenarios? And even if there's one edge case, you still have to handle that, right? And so that becomes the biggest challenge, is trusting the platform and the systems to make the right business decisions for the organization as a whole.
Yeah, I would totally agree with that. And I think, like you say, the idea of thinking a little bit outside of the box when we use AI is also, it brings benefits. So, we quite often think about AI, particularly around sort of application scoring, but especially in SME, using AI to segment different types of SMEs is also very valuable. Because, if I look at a company that, has two people in it, but one of them is a window cleaner and the other is a cutting edge bio development company, they might have some commonalities, but they're not the same at all. So if we can use the sort of AI technology to create good segmentations, like you say, John, that sort of builds the processing and the automation that we can bring in. And then I think the other benefit of AI is that there's different AI techniques. It's not just AI is one thing, and different techniques can be used for different things. So again, when we're talking about a probability of doing something and not doing something, it's binary. But different techniques can be used, for example, to also identify fraud networks, fraud rings. So that's really important. And there's, it's being able to, some of the challenges are being able to identify the right AI technique, right algorithms for the right problem. One of the things that we're really looking at the moment is really using ML ops to try and speed up the whole process of getting from data to model. And then once we've got that model, getting that model integrated into a decision, an operational decision flow, because I think that's been a big challenge for a lot of companies. I think, a lot of companies, you can hire graduates who've come out of university, they know how to code in Python, I'll do you an AI model, no problem. But the question is, and, John, looking at your side from an IT perspective, would you trust that to go into a core business operational system? And there needs to be that sort of wraparound so that, like you say, you have the confidence that, this is going to run correctly in that type of system. So, that's something that needs to be factored into how AI is actually running within an organization. And then, like Alex has said as well, that importance of explainability, because, the UK regulator isn't the only regulator that doesn't like a sort of black box in the decision process. So you have to be able to explain it. So the importance of being able to open the box and justify why the model made those decisions. So there's a lot of challenges about AI, and I think it's still one of these things that's talked about a lot. And I think there's still quite a long way to go to actually see the benefits that I think everybody envisions that could be there. But getting there is a journey.
Yeah, it's interesting. Some room for improvement. Well, that's always good. I'd like to move on now and look a little bit, look at integrations and speed. So being agile and getting to market with new offerings at speed is obviously critical to staying ahead of competition. How can technology help you adapt and scale your product offerings so you can get to market faster? And John, let's start with you on this one.
Sure. I think that this is an interesting question because there's a lot of different dimensions to this. I'll try to unpack a few of those. I think first off, there's always the trade-off about whether or not you should custom build your own solutions or leverage packaged software or SaaS-based solutions. And there's pros and cons to all of that, right? I think the speed to market really has to focus on one very important sort of dimension, which is what's our points of differentiation relative to our competitors. I've seen a lot of organizations historically invest in technology that it's basic capabilities that are sort of table stakes for the marketplace for the business that they're in. Yet it's all custom-based applications, hard to iterate, how to evolve, change. So I put it in two camps. Camp one is these are table stakes that anybody that's doing small business lending has to do and do well, right? There's an expectation of merchants that this is stuff you just do, right? And then there's points of differentiation. And so what we've tried to do is pivot to making sure that we really invest our resources and dollars in points of differentiation relative to the technology solutions we use. And that comes into play relative to your technology selections, right? If you can't actually have technology platforms and systems that allow you to move at pace, right? in line with the market expectations, then you're going to fall behind because your systems are an inhibitor to you. Probably one of the good examples of that is we've tried to really take a very disciplined approach to where we need to have things that we can configure outside of system software changes versus where we want system software changes. So if we have to make changes relative to pricing and credit risk scoring and other stuff, some of that is fundamentally externalized, if you will, where we can make those, in a pretty rapid time frame, right, as market condition changes versus have to initiate a software development build. And that's pretty critical, right? And if your software solutions don't facilitate some of that, then you're going to be a laggard. I also think that your technology choices become an integral part also of your cost to serve model, right? As we look at our cost to serve, I take a pretty critical look to how do our systems help facilitate how we actually serve customers by providing the products and services that they're looking for. And just because we could get to market faster, but it costs us 3x what it should, and therefore it has a degradation on our margin and profitability, that's not a healthy position to be in. So we've tried to be very cognizant of trying not to build custom applications where necessary. Right? We've leveraged a lot of software as a service solutions, things that can scale, so we can focus on delivering those points of differentiation when it comes to new products, services, and capabilities. And I think that allows you to really be much more responsive to the market, especially in the small business space where the dynamics of certain markets and geographies, and we've seen that over the last year or so post-COVID, right? Certain parts of the country have different demographic makeups of small businesses and what the appetite is from a risk perspective. And we have to pivot, right, pricing and risk and scoring and that sort of thing based on what markets we're serving, what industries we're serving, what do we see as certain trends. And so the systems have to be flexible to do that. And that's where we've made our investments. When it comes to table stakes, that's where we're actually just leveraging, base capabilities because we know that that's what the expectation is in the market.
Does anybody have anything to add?
Yeah, I think it's a very good point, and I think the sort of base point of that is, if you do it manually or you do it in an automated way, and a lot of traditional organisations were making decisions manually, and hence why companies like Alex's, like John's exist, and those sort of decisions can't be scalable. It's very difficult to keep adding people as the portfolio gets bigger and, you grow. I think also the whole sort of feedback loop, the whole retraining is just a key part of this. If you want to scale and you want to grow, you want to stay ahead of the market, then, you have to do that monitoring. You have to follow up on how effective your processes are. And then if you need to make changes, it's easier to train and change machines than it is to get humans to have different habits. So, really important to do that follow-up part and see how things are performing. Otherwise, like you say, the business will go backwards rather than forwards. Sorry, Alex, over to you.
Yeah, I was going to say one of the pitfalls certainly we found is that you've got to be careful about the kind of quantity of data that you're bringing down. So, for example, open banking, we selected a provider. It turns out they don't summarize any of their data, so it requires us to do the summaries. Similarly, open accounting data, actually, despite what the vendor tells you, it's really easy to use. It's actually quite difficult to extract the data from them and manipulate the data in a way that you can actually then make automated rule decisions, which is obviously the whole point of doing it. And I do think even if we've got a hybrid, partially automated, partially manual, having a solution that allows you to review and assess the data automatically, so that underwriters then reviewing the exceptions, still it will take a significant reduction in the amount of effort required to underwrite a case.
I would totally agree with that, Alex. And I think that's the benefit of automation, isn't it? Because even when you get an underwriter involved, you are able to point them at the things they need to look at. So rather than then looking at the whole application, you can say there's a problem with cash flow, look at cash flow. And it makes even the underwriting and the exceptions that John was talking about an awful lot easier to cope with and a lot better.
Okay, so we've talked a little bit about speed, but let's look at speed as it relates to rapid approvals. Why are rapid approvals so critical to SMEs, and how can digital lenders make them happen? Let's start with Alex on this one.
Okay. I mean, some research has been done on this, which helps to answer some of the questions. First of all, small micro-sized businesses are very, very poor at planning. Let's say they don't do much planning. It's usually a last-minute panic. They're running out of money and they need a loan yesterday, and it's and there's only a day to the weekend. Typically, they might have their head in the sand, and suddenly they've got to find the first application, the first lender, and they'll apply to that. They don't really look around the market. So in the UK, the SME market is still very, very far, a long way behind the consumer market. They don't think like this consumer does. So they might just go to the first lender they find. And if they don't choose you, they won't come back to you. So there is a sense that you've got to get it right first time. And they need to understand what is going to be the outcome of your decision quickly, because they've got to make decisions themselves, whether that is put it on their credit card, lay somebody off, or just sort of hide in a cupboard until hopefully it'll go away. And so what we've done is, how do we make this happen is, what we've done is we've removed the need to upload any documents. Still, a lot of companies are asking you to load management accounts, financial statements, copies of passports. Our view is that they shouldn't have to load anything up unless it's an exception. And as I was just covering on the previous question, we are able to sift through a lot of data very, very quickly via policy rules, our 3 logistic regression credit models, in order to be able to make a decision based on the exceptions. And what we do is we look at the exceptions, and then we'll pick up the phone to the borrower and see whether we can turn that refer into a pass. That way unlocking lending. And in the UK, what we've seen is there's been a number of lenders, such as Funding Circle, who have moved to a very, very algorithmic-driven approach. If you don't fit into their nice box, you're out. And therefore, they don't really have an exceptions team anymore. They've decided to get rid of them because really most of it is sort of automated. So that's where the likes of other lenders like ourselves come in, and we will then look at the exceptions and spend a bit more time with the borrower to try to turn that into a positive decision.
And I think the value of that, Alex, for your customers is, over the automated lending, is that I guess that creates very much that sort of long-term relationship that you have with your customers, that they're not just, a name, they're much more likely to recommend you because they feel you've gone the extra mile for them. So, that creates a really great USP for your company, doesn't it?
So they're very strong advocates, and then what we do is we remain in touch with them throughout the life of the loan, partly to make sure they're not going to go into arrears, but also to understand how their business is going, and therefore building that personal relationship so that if there is a problem, they'll pick up the phone to us before they'll pick up the phone to another lender, and therefore we can help them through that process. So, as you say, we see very much building a positive relationship to get that brand loyalty, which they will then pass on to other people in their space, and therefore you'll be able to get a lower cost of origination going forward.
And John, did you have anything to add on this?
Yeah, sure. Just to supplement kind of what Alex said, I agree with all of his points. I think in the U.S., very specifically, speed is sort of the name of the game, right? There's certainly a lot of players in the marketplace that a small business can go. Interestingly enough, our stats suggest that 60% of the people that apply, or the business that apply for funding from us, are doing it on a mobile device, which means they're out in the community. They're looking for speed and efficiency. They're looking for a frictionless process, right? And they're looking for an answer quickly. And so we always are continually trying to innovate to recognize that we have a very diverse, merchant customer base that is is sort of our national population, and how do we really make that as seamless as possible, but also giving it the human sort of component. But fundamentally, businesses are sort of oftentimes sort of ill prepared for really understanding their cash flows. I think Alex was spot on that. And so rapid funding is really important to them. And every small business has a different preference, right? Some of them care about rates, some of them care about duration, some of them care just about the payment, how much I got to pay, right? And so giving them very flexible options in terms of the different offers you can afford to them, and what their choices are becomes really, really important, right? As opposed to, we only have this, and if you don't want this, we can help you. So the diversity of products and offerings in concert with speed are absolutely a differentiator. And we have, competitor information relative to other lenders like us that substantiates some of the speed points, right? In terms of how quickly can we come back with a decision and give flexible offers to the merchant that they can sort of choose from. And so when you do that, typically, the first one or two offers that come through are the ones that win, right? And merchants often take it because time is money for them, right? They're not sitting behind a desk typically, right? They're like out in the community running their businesses every day. They need a fast source of funds. You're an outlet, but there's many other outlets out there. So how do you differentiate on speed? And that's one thing that we've been focused on, certainly as an organization.
Yeah, and I think that joins very nicely with what Alex was saying, because somebody's out and about, and then you say, you need to send me this document and upload this document and this document, they're not going to do it. So, your drop-off rate goes through the roof, doesn't it? So, it's been able to use data sources to the best way possible to avoid those necessity of, scan me a document, send me this, that, and the other, and being able to integrate that data seamlessly into your decision process, isn't it? So that you can get that speed of response out.
Great. Okay. Well, we have time for about one more question. Before we jump into that one, I did want to stop and remind the audience that we are taking questions and answers. The panelists will be at the end. So if you have questions, feel free to input them now. You can always input them at the end as well, but now would be a great time to do that. So please keep those in mind. Okay, so now let's turn and look towards the future, which is always important when we think about fintech, because kind of the future is always now somehow. It always just keeps moving forward. So what do you see for the future of SME lending? And I'll open this to the floor.
So I would say certain and uncertain. Because I think certain in that I think what will stay the same is that SME will always be the bedrock, the foundation of every country's economy, and that will always be there. I would add the uncertain to that, because I think obviously with everything that's going on at the moment, running an SME, running a startup, it is always a slightly hazardous affair. And in today's economic conditions, it only becomes a tougher challenge to run. And I think, that reinforces all the points that we've made about, the speed of decision, being able to get a 360 view, because that protects the customer and stops them getting into debt that they can't repay. It protects the lenders, because they're going to be making good business, which is also important going forward. So, I think that's certain and uncertain. I think what we're seeing from our point of view is that people are still seeing SME as a very interesting niche. And taking products which have been launched in the consumer space and then moving them into the SME space is a trend that we've seen for quite a few years, and we're still seeing now with sort of, I would say, something like buy now, pay later probably being a very current topic of conversation. And also, I think the other thing, and it's a little bit sort of by the side, we've referred to it, but it's a bit by the side of what we've been talking about today, but the necessity of that ongoing monitoring, because it's all very well making a good decision on day one, but, SMEs are very, they're very susceptible to changes, and their situation can change very rapidly. So as a lender, you have to stay on top of that and keep those lines of communication open and see what's going on with those customers. Not only, it works both ways around again, helping customers stay in good financial health, but also giving them better service, because if I know that this is an SME that's managing really well their finances and they come back for a follow-up product, I can give them even better service because I already know so much about them and what they are as a company. So yeah, certain and uncertain.
Great. John or Alex?
I think as I kind of mentioned, I think certainly in the UK that it seems to be that when you become an SME owner, you kind of lose all sense of what you were like when you're a consumer in the finance world. So I think the areas that the SMEs are going to get more kind of aware of, what is my credit score? Yes, every time you apply for a loan, that appears as a search on your record. Oh, did you know that? I didn't even think that my business loan appeared on my business credit report. And these are comments from the bureaus where they've been picking out that information. So I think there'll be a lot more savvy, data-driven SME owners in the future. We believe the one area that will also be improved is playing back information to borrowers. Why didn't they get a loan? What could they be doing differently to get a loan next time? And these are the areas of your strengths and weaknesses. And that's something that we're certainly talking to bureaus about how we can play back some of their data to the borrower, along with the publicly available data and their own data through open banking and open accounting, so that you can give them a kind of a health check on how they could be doing better in running their business. So, and we're not the only ones doing that. I think everyone's piling into that now. But that seems to be, I think, where we're going. So we're going to see SMEs moving to become much more like consumers when it comes to borrowing, when we're talking about small businesses anyway.
And I think that's right, Alex, isn't it? Because I think that creates a lot of the frustration for small business owners, because I go into my bank as me, and you give me a credit card like that. I go into my bank the next day as my business owner, and suddenly it takes so much longer to give me the same service, and it's like that not understanding, isn't it? So yeah, I think you're dead right.
I think one of the things that that I think will be interesting to sort of see in the marketplace is how small businesses and then subsequently lenders pivot to a relationship-based orientation from a transactional one. As you think about markets potentially tightening, talks of recession globally, certainly here in the U.S., right? I think there's going to be more merchants that are going to really want to be able to say, I have a funding partner I can trust, right? Versus I did a funding transaction with that company. There's a big difference between those two, right? And so if you can be the funding engine for this company, because we've lent them money, they're on a growth trajectory, we can support them, right? And be their go-to source, that's going to be really important. That stickiness factor. And I think certainly in the US, there's probably less of a stickiness factor when it comes to SME lending. And I think in the future, there could be a greater opportunity to really sort of build that, right? So when I think about, for us, what's important to us, frictionless experience with a personal touch, right? So we can sort of build those relationships and recognize the fact that this business has an immediate need, but they're also trying to grow a business over the long term, right? And can we be their funding partner of choice, right, when they have lots of choices in the marketplace? And I think that's going to be crucially important.
Yeah, and I think that there's an awful lot of research to back that up, isn't there, John, to show that a customer that you've pulled out of a mess is one of your best advocates, whereas a customer that's never been in a mess, like you say, is like, well, you're no different to anybody else. So, yeah, really important.
Yeah, interesting. There has been a lot of competition rising these past few years, so it's good to stay on top. Great. All right. Any other thoughts before I move us along to Q&A? Any other thoughts on the future of SME lending? Okay. All right. Well, that brings us to the Q&A portion of today's webinar. So we've had a few rolling in. Feel free to continue to submit your comments here. So let's start with this one. It says, how how have you found the rollout of open banking across Europe when looking to target business accounts? We've seen a lot of fragmentation across the players.
So I think Alex talked about a little bit about that earlier.
Yeah.
So maybe Alex, you want to expand on what you said?
Yeah, what we did was we were with one supplier, and so we had we had a sample of 150,000 transactions. And what we did was we did talk to and it's correct, there are a lot of people in this space, and they all claim to be amazing. And we did a lot of conversations, and either they wanted to charge a lot of money or it wasn't quite right. And we ended up narrowing it down to two providers. We presented them with the 150,000 records. And in the SME market, the key thing is about categorization. And we got them both to put them through the categorization engines, and we then compared the two providers. And we selected the one that had the best categorization initially. The issue with, as I was saying, the issue is that they don't summarize the data. So when we're working with our colleagues at Provenir, it's proven that their technology simply cannot process the data quick enough to be able to stop a backlog of transactions behind it. And so we would have to build it in-house, which is really not something we could do, but prefer not to do. So then we've been looking at the second choice. It was very, very marginal, to be fair. And they have focused solely on this space, and they're a tech-driven company. So we're seeing that they've developed, a more advanced solution than some of the other providers, because it's their core business. But we do have but the issue is, even so, they don't cover all the banks. So you might find one covering this bank, but the other one doesn't cover that bank. So it's a little bit frustrating that they haven't got everyone on their books yet. I imagine that will come with time. But in the meantime, you've got my CEO shouting at me as to why can't we deal with this customer, because that bank isn't on the platform.
That's interesting. Yeah, so still some progress to be made. Any other thoughts from our panelists on open banking?
I mean, I think the point that Alex made is totally correct, and what he's saying for SME, has been true in the consumer space for a little while. In that categorization is really important, and it's really one of the questions to ask providers when you're doing your tour of the who's out in the marketplace. Because a lot of people say, yeah, we can do open banking, but have they actually trained the categorization algorithms for that country? And these are things that you really need to be aware of, so you know what you're getting yourself into, and not a whole heap of data that you have to process yourself.
Yeah, interesting point there. Yeah. So we had another question on open banking as well. So let's move on to that one. It says, open banking has been mentioned several times and can play a key role in making SME lending decisions, as well as improve drop-off rates. How must open banking providers adapt and improve in order to provide the required data summaries for SME lenders to use?
I mean, I would say because there's a very similar pattern to what we've already experienced in the consumer space, and it is all about that training the algorithms, because when you go into a market, you can get the raw data back, but the raw data is very clunky and very difficult to process and use in a meaningful way. It goes back to John's thing earlier, you can have your big data lake and swim in the data, but you can't see the picture in it. And it takes time for companies to refine those algorithms to categorize correctly. And then sort of the next level on from that is not just give me a categorization, but, build the key variables on top of that, those categorizations. So what does that mean as far as cash flow? What are there outgoings in there that are worrying, that you wouldn't expect to see? So that, the data provider is already starting to give you pointers towards the quality and the message that's in that data.
Yeah, I would agree with that. I mean, a good example of difficulty in categorization was one of our borrowers was a car dealership. And so the categorization was showing that the car dealer was borrowing lots of money from car finance companies. Actually, that was its income, but it was being treated as loans coming into the business.
As outgoings, yeah.
Yeah, so as new loans been drawn on the business, which was clearly wrong. So it just shows how difficult it is. I think there are some providers who are now, they're even giving you predictive scores of what they think the future forecast will be for the next 3, 6, 9, 12 months, and what the credit score is for the business based on the information they've seen. And I think it's a combination. I had a conversation earlier today about, well, isn't open accounting simply going to replace open banking? And I think the answer is maybe, but not at the prices they're charging for open accounting. So it will be there to stay, or it will be a supplementary to the open accounting information that we'll be able to collect.
Interesting. Yeah. All right. So let's move on. This question is for Alex. How do you balance the need for KYC validation and the customer experience? That's a tough question to answer. I'm curious to hear.
So we do electronic KYC on directors and owners of the business. So that is behind the scenes. If they don't meet our rules, then we will serve up a QR code, and they will then need to take a selfie alongside their copy of their passport or driving license and upload their proof of address. We won't stop the application. We will then let them carry on, and then we will sort of review the results when we get to the underwrite stage.
All right. John, do you have any thoughts on this?
Yeah, sure. This was an interesting one for us because we had to sort of experiment with a couple different options. We wanted to really, as you know, from a SME standpoint, many of these businesses are sort of sole proprietorship, single or two owner sort of businesses. And so the authenticity and accuracy of the actual owners of the business is just as important as the business themselves. So we experimented with some KYC sort of owner identification processes very early on as you sort of take the application. And what we found that it didn't really go very well. There was a pretty big drop-off rate because the people that were applying, sometimes organizations had their finance director apply, right? They're not the owner, but yet we're trying to validate ownership data, and they don't have all the answers, right? So they just stop the process and go elsewhere, right? So it was causing friction in our process. And so we decided to sort of pivot on that and really sort of put the sort of the KYC piece really kind of at the end of our process, really before we're ready for finalizing, a merchant's funding. A much better receptive, right? It fit much better with the expectation model of the merchant and the owners behind that small business, and it's worked out very well for us. So, where you put it in your process is really important, and it's about your risk appetite and what you really want to validate when. But you also have to have that sort of customer-centric view of who's on the other side of that web page or that mobile app, and what are they trying to accomplish? What's their intent? And for us, I think we understood the intent, but we really didn't understand the audience nearly as well. And so when we made that pivot, it produced much better results for us.
Great. Corinne, did you have anything to add to this one on KYC?
No, I think Alex and John have done a really good job of answering. So,
all right.
Thank you.
Perfect. So we'll move on to this one. It says, how open do you think SME lenders are to white label solutions which embed their offering into other services? And I'll open it to the floor.
I'm happy to start on this one.
Two lenders on the panel, so.
Yeah, no, I mean, we, in the U.S., the market is very much mixed because you've got organizations like ours that are originators as well as lenders, right? We sort of serve both sides of the coin, if you will. And we've actually seen a stronger appetite to white labeling, and we're in the middle of early stages of a partnership to do exactly that, where we're providing our lending solutions to other organizations that are embedding our services into their overall portfolio of services they provide their small businesses. And this type of lending is one example where they had a gap, right, in terms of what their customers were looking for. They had no way to fill it, and we're helping to sort of fill that in sort of a white label context. So I think the appetite is there. I don't think it has gotten nearly as much broader market adoption, but as companies demonstrate they have technologies that are flexible enough to have that sort of consumption and being offered a white label services, I think you'll see more of that in the marketplace because it diversifies the breadth and reach into the small business space. So,
interesting.
Yeah.
Alex, do you have anything? Yeah.
Yeah, I mean, from the UK point of view, I mean, it sounds interesting what John was saying, and what we're seeing is that there is a demand by the challenger banks to enter the market that Askif is in, but at significant volumes, really, really large volumes. So they are interested in white labeling. The question is what will they want for it? Exclusivity, for example, wouldn't really work, but would they be comfortable us doing white labeling for one neobank, a challenger bank, and white labeling for another challenger bank who are at loggerheads with each other? So I think we're probably a little way away from that in the UK. It isn't the way it's going, but you never know what's going to happen, and we're in a very strange world. If we could negotiate a deal where we could have both of them, then I think, yes, it could work for us.
Yeah, interesting.
And I think the point that John made is really important, that the technology enabling that again, because if we go back a few years, it would have been very difficult to do that sort of embedding a sort of the calls that the lenders are doing into a platform. These days, the technology supports that so much more. So this is really powering this sort of opening up the market. And allowing new entrants to come into it who, don't want to do the lending side. That's not their expertise, but they're sort of plugging in that sort of finance as a service into a wider offering.
Yeah. So, Corinne, this next question is for you. It says, what are the biggest challenges your customers face in enabling more rapid credit approvals for SMEs, and how does Provenir help them overcome these challenges?
Okay, so I think a lot of these points, have been very well described by John and Alex during the webinar. So just to sort of reinforce some of those points, some of the key things that we're looking at in this sector is being able to make very bespoke decisions in a very short space of time on a very diverse population. So that in itself is a very challenging dynamic that you're trying to answer to. And, the role of technology in that is really key. And, that's the piece of the jigsaw that Provenir is trying to provide. So enabling you to draw on all of those data sources. We've talked about, open banking, open accounting, doing sort of like your KYC checks in an automated way. So all of those remove time from the process, and all of those remove dropouts. But okay, once you've got the data, you still have to do something with it. So again, we're looking at being able to make that decision process as technical as you want to make it. So if you're interested in using sort of latest cutting edge technology like ML, AI, we can do that. We can provide that and support that. But in a UI that enables Alex, to quote Alex, people like Alex to be able to do those sort of changes very quickly and confidently, even though, that's maybe something that they wouldn't have been expected to do. So making a platform, a UI that is very interactive and people are happy to do it. But doing all that in a way that keeps people like John happy, so that, it fits in with proper sort of IT, version control. We're not going to put something into a core business, platform that's going to knock the whole business out because somebody put something live that they shouldn't put live. It wasn't tested, it wasn't approved. So making sure that, the users get the input, but in a way that's actually controlled and supports the business being available and up and, giving good service to customers. So I hope that answers some of that question.
Yeah. Okay, so let's move to the next question is for John. How do you ensure that Reliant Funding offers a differentiated experience for your customers? And what are some exciting tech innovations in lending that you've seen in the past few years?
Sure. From an experience standpoint, I think it really has two dimensions, right? One for us is frictionless, right? I think we have a lot of data on when merchants apply for funding, some of the hurdles and where the process breaks down currently, where they struggle, right? As I mentioned, sort of the mobile dimension, right? How robust and engaging is that mobile application to be able to sort of apply very easily, right? The document comment that came up earlier, if you're on your mobile device, you're not uploading, documents very easily, right? It's not sitting on your mobile device. So thinking through the frictionless aspect of how do we make this frictionless and easy and simple? And then incorporating, like I said earlier, a little bit as the human touch, right? How do we build a relational connection with those individuals and not make it so sterile that all they see is a web screen or a mobile app, but there's no sort of human sort of dimension to it. If we want to make the relationship the focus and less around transactioning by giving funding, then we have to sort of be able to have both of those. The technology enables a better engaged experience between the merchant and our organization. From a technology perspective, I think probably the most exciting thing, and I wouldn't say it's sort of emergent as much as sort of the application of is really machine learning, right? I think machine learning, like a lot of innovative technologies, gets a lot of buzz. A lot of companies go down the path and charge the hill, right, with fanfare, and then they go, now what do we do with it, right? How do we use it, right? So it's sort of a technology looking for a problem, right? And so when I talked a little bit earlier about the funnel, right, we're trying to really apply that technology in a meaningful way to how we run our business. How do we continue to drive margin growth? How do we continue to drive efficiency, right, by still having the human touch, but only where it adds value, right? Having someone manually pushing 10 buttons to get an application through the process, and those 10 buttons don't add value, is a waste of time and energy, right? They could be expended elsewhere. So how do we leverage machine learning to drive better predictability, ensuring that we're going after the right opportunities for merchants, ensuring that we're facilitating the right sort of credit and decisioning processes? And I think leveraging those all in concert and thinking about it from a profitability standpoint is a very important consideration, because technology can really be a fairly big cost component of any organization if it's not applied properly. So the business becomes an integral part of really trying to leverage that technology in an effective way.
Yeah, really. All right. Well, that is the last question we have time for. I want to thank you so much to our audience, also to Provenir for sponsoring this panel discussion, and of course to our panel participants, Alex Daly with Ask Inclusive Finance, Corinne Llelti with Provenir, and John Pesavento with Reliant Funding. Thank you so much, everyone.
Thank you, Judy.